back to JPX and market weekly updates. Last week, oil was positive for much of the trading session after comments from Saudi Arabia simply putting a floor onto the market. However, there are increasing signs that the Iran nuclear deal is on the brink of being revived, as the United States has sent a response to the European Union on a proposal to try to save the deal. Investors still remain cautious when taking a long position. Middle East medium sulfur prices has rallied by around 6% since Saudi made the comments. The Dubai benchmark was assessed at a nearly 4-week high of $98.8 per barrel last Thursday. Although prices were lower Friday, it still made gains versus North Sea market, crunching the November Brent in Dubai cash price by more than 70 cents a barrel on the day to just $1 a barrel, and the narrowest since late 2020. While JPX Dubai NIC Brent November contract was trading at equally $92 and $99 per barrel. More specifically, Saudi Arabia and its minister said extreme volatility and lack of liquidity means the future market is increasingly disconnected from broader market fundamentals and that OPEC Plus may force to cut production. This is a strong signal Saudi sends the market that it will continue to manage oil supply. Prices have also found support in the later part of the week amid a growing consensus among OPEC producers that a quota reduction is on the cards, with a host of producer countries backing Saudi comments. An immediate output cut is unlikely, with the group set increased quotas by a modest 100,000 barrels per day in September, but the wider OPEC Plus group expected to keep production as an option in the event of sanctions may be lifted against Iran, or a sharp turn down in demand, and monthly meeting structure provides a mechanism for rapid production pivots. On the demand side, investors globally kept a close watch on the Federal Reserve Chairman's remarks on Friday. In a keynote speech at the Federal Reserve annual meeting, Powell said the path to reducing inflation will not be quick or easy, adding the task required using the tools forcefully to bring demand and supply into better balance. Doing so would likely result in some weakening of the U.S. economy and job markets. While Powell did not offer any indication whether the Fed rate hikes of 75 basis points each would be repeated at its meeting next month, it sent the clearest message yet that right now fighting inflation is more important than supporting growth, and the central bank was committed to more restrictive policy in order to rein inflation. While macroeconomic outlook remained challenging due to a lower growth outlook and recent dollar strength, the oil product market have nevertheless made a strong rebound this past week. Asian diesel cracks in Singapore hit a fresh 7-week high as Wednesday EI report added further bullish pressure to the middle distillate market. The data showed that U.S. distillate stock fell unexpectedly in the third week of August as the export jumped to a 1-month high. Diesel prices have demonstrated exceptional strength this year, flipping into a premium of gasoline of some $20 a barrel over the summer month, and the market data indicates that this trend is far from over. In the European market, diesel cracks may rise to $17 a barrel again this winter, with Europe short around 1.5 million barrels of gas oil, and that may be exceeded as consumer gas oil switching picks up. On the other hand, European natural gas prices resume its upward trend, with the benchmark TTF price for October trading in fresh highs of over €300 per megawatt hour late Friday, in part lifted by delays to restart of U.S. Freeport LNG terminal. As an increase of $10 per million British thermal hits in the natural gas price usually adds around $1 to $1.50 a barrel to refiners' variable energy costs, there is little chance for downside in product cracks, as high production costs remain little affected by changes to crude oil supply. These higher costs are likely to be passed through to consumers amid persistent price volatility and pose a tougher challenge to control inflation. Okay, that's all for today, and welcome back next week.